About every 20 years or so, we have a major market crash and where the market goes down 50% or more. You can see it in a long-term chart. I mean, it's not perfect by any means, but like from 1900 to 1920, the market went totally nowhere, sideways for 20 years. Then it goes straight up for about 7 or 8 years. 1929, it crashes. And then the market got back to where it was in 1929 by 1955, so that was 26 years. Then it goes up for another, 10 years or so, and then it just goes crashing down and went sideways for the next 20 years. And then it goes up, 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 up from 1980 to 2000. And then we've had 2 major crashes since then. Nobody knows for sure, right? But what we do know is, as Jamie Dimon says, that every 5 to 7 years or so, we have a recession. And the market responds to those in major ways. That's because recessions come about because of too much credit. Right now, we have more credit being extended than we've ever had in history. So some people are thinking we may be looking into the teeth of one of the major market crashes we've ever had. On the other hand, everything seems to be going pretty good right now. So we don't know for sure. We're going to talk today about how the coronavirus has impacted the stock market. And I think almost you'd have to be living on Mars not to realize that there's been this enormous stock market drop just over the last few weeks that has cratered the stock market down well into the 30% range and then rebounded aggressively as the Federal Reserve and the Congress, President of the United States all step in to try to offset the huge amount of changes going on in the economy. And by the way, this is a worldwide event. This is an event. If you weren't sure what a Rule 1 event looks like, this is a Rule 1 event, and this is super impacting the market. And what that means is that should this continue, eventually very, very good companies are going to go massively on sale for no problems of their own and no problems in their industry even, just because everything went on sale as a result of this gigantic worldwide problem. Now, I say that as if there are companies that are going to somehow escape the problem. And, crazily, if you didn't already realize it, there are companies that are escaping the problem. In fact, there are companies right now that are doing extremely well. Not the least of them is Kroger grocery stores and other grocery stores that are seeing a whirlwind of business and are just reaping the benefit of that. Trying to keep the stores stocked is a real challenge for them. And that's the case on almost every kind of event that happens out there, is that it creates an enormous wave of fear. That fear drives people out of the market, and so all stocks fall, even the ones that are doing well. Remember, a lot of times I talk here about Chipotle Mexican Grill, but that was a stock that was impacted dramatically in the 2008 big recession and drop. And yet it was doing better than it had ever done. It was growing at 20% a year. It was growing its free cash flow. It had no debt. It was as if the market plummet had nothing to do with it at all. And that's kind of what we're looking for out there, you guys. We want to look for companies that are not being directly impacted by the event in some way that could be terminal. In general, what we were experiencing looking back on it was stagflation. We had inflation growing, we had stagnant economy. GDP wasn't particularly growing, but it wasn't particularly shrinking. And maybe that's where we're headed here as the Federal Reserve continues to pile money in. The point is, nobody knows. And because nobody knows, it's a really important, I think, to pay attention to what Warren Buffett is doing right now. And that just came out over the last couple of weeks that he is not buying anything. He didn't buy anything at all when the market crashed down 37%. And people asked why, and his answer was because there was nothing I thought was really a good deal. What that tells me, and he also is basically saying the same thing he's always said, which is, I really don't know where this market's going, and I'm sure that's the truth. But he's certainly leaning one direction, and that is he has $130 billion in cash, which, if my calculations are right, is 3 times more than he's ever had in his entire life of investing in cash. And that, to me, speaks louder than words. It says, from Buffett's perspective, we're going to be in it for a while, and we're going to see these companies, these industries like airlines, restaurants, energy, banking, and so on, start to have more and more problems and start to have many companies start to fail. And when that happens, fear begins to grow as investors lose their money in these companies and people start to sort of bail out of the stock market. I think there's a real potential for a major bailout of the market here, which would cause the markets to drop a lot, simply because over the last 40 years, these markets have been driven up past anything reasonable, predominantly by baby boomer money. Okay, my generation, the largest generation in our country until, I forget what it is, the millennials came along. But we are the ones with all the money right now, and that money is majorly invested in the stock market. And because it is, if fear starts to grow among baby boomers who are headed toward retirement, then you could see a real shakedown. In other words, if a person's 50 years old and they see that, it might take 10 years for the market to recover, they've got 10 years. They're not retired yet. They're not planning on retiring for maybe 15 or 20. But if a person is 65 years old and just ready to be retired or already in retirement, then they're looking at a 10-year period when the market might not go anywhere. And that could be a crisis. If it's going way down and then come back up, it's going to be very hard for those people to stay with it. And as a result, you may see that money that's been pumping the market for 40 years start to fly out into even bonds at 2%. So here's what I would suggest you guys think about doing. I would follow Buffett here. And this is not advice. It's not a recommendation. It's just my opinion, right? And just trying to be a little bit educational here. I would follow Buffett. I would lean on that. And I would say, that guy's in cash. And he's in cash because he doesn't see anything that's really a great deal right now. So I might think the great deals are on their way. So in this world of, haves and have-nots, we're going to see a lot of social strife, regardless of the fact that the Democrats won. It'll get worse. So you want to be an asset owner in this environment. You want to own things that will appreciate as the dollar is devalued. And those assets include gold, which is a pretty obvious asset to own. Now gold isn't an investment. Gold is a hedge on a currency. It's a currency, and we're going to choose to have some of our capital in gold as a currency rather than in dollars as a currency. And we will be hedging the dollar with that gold in the belief that this devaluation will continue. So there's a currency. Silver is a currency. Gold mines and silver mines are assets that will appreciate rapidly in a currency devaluation environment because the value of the thing that they're pulling out of the ground is increasing day by day in that environment. So those are all good ideas for this sort of scenario. And the next level of idea is a commodity related, right? So gold's a kind of a commodity. Other commodities include farmland, companies that make money out of farming, out of food production, cattle, companies that provide it, companies that put it out there. So that group of companies might include, companies, I don't know, like Smithfields. I guess they've been sold to the Chinese, but companies that actually produce hard goods, food that people will need and will pay for, are going to do pretty well. And by the way, just as an aside here, you've got to be very careful about the companies you're choosing, because while you may want to take on debt as an individual citizen, you have to be very careful of getting into a company that takes on a lot of debt and maybe takes on too much. So we want to be very aware that some debt is okay, but too much debt can kill. And the reason for that is that these companies, if they get into trouble, their CEOs will have no problem whatsoever taking the company into Chapter 11 bankruptcy to unload the debt. So, there's no way, you guys, there's no way anybody on this planet knows what's going to happen to this market. So we have to invest as if what's going on in the market does not matter. And the first thing to do that is have confidence in your investing strategy. Have confidence that you are able to figure out a handful of businesses and understand them enough to know that they have a solid moat, good management, and you know what price you want to pay. And then stay rational when things are going bonkers, volatility's all over the place. When people are saying all kinds of things about all kinds of people, try to just stay rational. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.